for joining the energy trading session. A new market is emerging for the energy commodities market on new technologies, decarbonization, and increasing exports of oil and LNG. This is changing the market structure and creating a new framework for pricing, for trading, for contracting, for marketing, and other commercial mechanisms. Addressing these issues today, we have for oil, Margarita Brouwer-Boulankova, and for LNG and natural gas, we have Madeline Jowdy, and for the new Chinese oil futures contract, we have Professor Ron Riffle. And I'll hand the floor over to Margarita.
Thank you, Tina, and good afternoon, everybody. It's a pleasure to be here. I have to say I attended a few of the presentations yesterday, today, and I'm really impressed with all the information. So maybe a disclaimer to start with, that I'm not an academic. I'm actually a banker, and I used to be a trader. So although I do use statistics, I hope I'm not going to dive into those too much, because I'm not going to be able to answer all the statistical question and regression analysis. So what are we talking today about? We are talking about crude and refined products, which is the largest commodity traded in the world. And the market is really changing. The production is growing, the dynamics are changing, and the market is influenced by many different things aside from the fundamentals, which is the traditional supply and demand, but also the financial markets, and also all the noise that we have in the market. So now I've just mentioned about the financial markets, and maybe you wonder what it is. So I actually wonder if anyone in the audience is a trader or works for a commodity shop? No? Okay, so why don't you gonna be, anyone? Excellent, so we have one. So why don't we gonna first define the physical traders and the financial traders, and we have perfect split of the room here. So you're gonna be financial traders and you're gonna be physical traders. So why do I want to define the difference between the two is because the trading dynamics of the physical trader and the financial trader is very different. So a physical trader, you're here, you're actually moving the barrels physically. And financial traders over here, you're really more taking a view on the market and you try to put on your positions to benefit from those. So let's have a look what financial traders does. And I've here put basically a supply chain of crude and refined products, and everything which is highlighted in red is what's being touched by a physical trader. So a physical trader picks up crude oil from a producer. It uses different transportation means to move the goods to storage. Then it could sell it to the refineries or export it, and then repeat the cycle on the refined products. Along the chain, we do have financial markets being present, either for hedging purposes or for speculative purposes. So I did say that we're going to look a little bit at statistics, but really please don't go into depth into analyzing those, because I'm sure you know those numbers better than I do. But what I wanted to show is really that, as we know, that global production is growing, and the US is really complementing 18% of what's being produced in the world. So it's really becoming to play a bigger role in the global markets. US has pretty unique trading opportunities from our perspective, because it has such a huge domestic environment, domestic market, because the consumption is so big. But we're not going to go into it, because that's a traditional market that's been happening for many years. What's more interesting is, of course, what's happening in the import, and even more so on the export market. So let's have a look what's happening on the import market. US traditionally imported a lot, and primarily for those who are interested in the countries, I've chosen quite a few of those. But we've seen a decline in the importing numbers. So what does it mean for a physical trader? you're looking for different opportunities, right? Does a financial trader has any interest in any import changes? What do you think?
Exchange rate movements.
Hmm?
Exchange rate movements will be different.
Yeah.
So it's different risks.
Yeah. So let's have a look what happens on the export side. That obviously has been a hot topic recently. Since the export ban has been lifted, the US really started to open up. The start was a little bit slow because the market had to figure out which countries can take the US crude, which refiners can take the US crude, but it really has picked up tremendously. So in 2017, it's about 1.1 million barrels a day that has been exported, and year to date, 2018, it's basically double of that. And although even before the export ban was lifted, we saw some of the crude going to Canada, but right now it really goes to about 30 countries, led by China, and followed by UK and the Netherlands. And I didn't treat the Netherlands numbers, by the way, just because ABN AMRO is a Dutch bank. So if I lost some of you along the way, we're going to look at one more item, which is the refined products, which is also interesting. And actually here, I don't know if you noticed, but the prior slides, I've looked at data from 2010 to 2017, because that's where the dynamics have started to change more and evolve. But for the refined products, I looked back a little bit further to 2000, because that's where we saw the biggest increase. That's where we saw a lot more activities on the refined products starting to pick it up. And those are primarily exports from 2000 to 2010 have increased 130% and picked up another 80% in the last 7 years. And most of the exports that we see are about the distillates. So for those of you who just came in, you didn't miss anything, because all of what I've just said basically can be illustrated in the next two map cards. So the first one is basically what I've just mentioned. It's all illustrated here, somewhat condensed. We saw a decade ago US in the global market as more of an importer, as a little bit of exporter, and I obviously didn't use all the countries that US works with, but mostly just a selection of the larger volumes that we see in the trading market, and a little bit of export of crude oil going to Canada. So how does this map look right now? Something like this. I'm not an artist, obviously, but I did my best. So we see a lot more actually export going on. We see a lot more coverage of the globe, and more going to, not so much more concentrated on Latin and Europe, going more to Asia, and more importantly, there's more activity about exports of crude. So really the market tries to see. So now let's have a look how all this supply and demand data is being read by basically and traded by traders, because that's what we're talking about here, right? So I've decided to look at two time spreads that I wanted to show you. And before I click to one, we're not going to be looking at just directional price, because for a trader, just price goes up and down, it really doesn't matter. You can hedge it. It's more interesting what kind of spreads you're putting on, and this is where you can make more money. So now both of you will be active, the financial and the physical traders. I'd like to hear your views. So the one is very interesting, the contango and backwardation, and I wonder again from the audience how many of you are familiar with those price structures? I see. Oh, okay, quite a good participation here, so I don't have to go too much into details, and just in a nutshell, for those who don't know, basically contango or carry is that when the today's price is cheaper than tomorrow's price, and the backwardation is the opposite. Today's price is more expensive than tomorrow's price. But obviously the market doesn't trade just one day. Quite often we see market trading, let's say, a 1 month or 6 months. So this particular graph actually, I've taken a WTI 6-month spread for October 2018 to April 2019, and I've learned from other presentation supporting to say it is a daily data, so not a monthly but a daily. And so what do we see and what does it mean for traders? Because again, here comes really what we started the presentation with. is that a physical trader, how does a physical trader this market, trades that market? So when the market is in carry, that means it's really an oversupply. And we actually see that I try to make those little boxes. So when the first box starts the contango one, we see the price also collapse, right? That's when the market was in oversupply in 2014. There was not enough demand, the market was in oversupply, we saw a price drop, but more importantly, the market was in oversupply, so it was in contango. So what do the physical traders start to do? They start to put all the crude oil they can get to storages. They can even, I believe in the news, it was all over the news, oh, the vessels on all over the ocean full with crude oil floating because there's no space to do. What do financial markets do? They just put financial spreads in it, right? They buy one contract and they sell the other one and just sit on it. But then when the market becomes really an oversupply, the market breaks. The contango goes into backwardation. We saw this when when the announcement came with that OPEC and non-OPEC countries are going to cut the production. So we saw the market started to correct itself, the WTI, the Brad price started to go up, and then the market flipped to contango. It stayed there a little bit in contango for a little bit, and then the price can be, the market can move from contango to backwardation at any time, depending on either a large geopolitical event, economical event, or also it can be influenced by small events. And I picked up a few just as an example for the Hurricane Harvey, for instance, last year, when we saw that the crude was congested at Cushing, couldn't come into the Gulf, and the refined product couldn't come out of the Gulf. So we saw a little bit of change in the market, because I'm looking at the WTI contract. It became a little bit in the contango, in contango. And then since then, it's been basically in backwardation. So again, financial markets and physical markets trade those positions very differently. And financial markets, for physical markets, it's really when the market is in backwardation, you try to get rid of your barrels as soon as possible. And it really impacts a lot of the physical market, because it's how does it impact the MLP? How does it impact the demand for the vessels? For financial markets, it's, guys, if you moved your positions on time, you made a lot of money. If not, then you lost a bit of money. And during the risk management session, we'll talk about this a little bit more, how to basically, how you can hedge it. So one other price graph that I thought it was interesting to look at, also from a trading perspective, is about the WTI Brad spread. And this spread was really not interesting at all in the past, because it was historically always WTI was trading at the discount from Brad. So not much was going on until the export ban was lifted, right? So then the market again shrank, and then we saw a very, very narrow spread. And then again, I've used actually the same events, the Hurricane Harvey and the pipeline disruption, just to show also how the local market, the events in the local physical market can impact the spread. And what's interesting is actually for this spread, even more so than for the contango and backwardation spread, is because where the financial market can really influence the physical market is that from the normal analysis, fundamental analysis, you would say, wait a second, now the market is stabilized, the spread has to be, I don't know, $1. And then all of a sudden, financial markets are not liquidating their positions, and then it completely distracts and creates a lot of noise what happens in the physical market. So having said all that, I'll move on to my final remarks, just to say that it is a very interesting and exciting time. It is very challenging, especially for the physical traders, because for physical traders it's no longer you buy crude, you add $1, you move it somewhere else, and you benefit from it. It's really more watching what's happening in the market. There's a lot of investment money coming into it from the funds and proprietary traders firms. And what also interesting is because the market has so evolved in the physical trading market, that if before you had a function of, let's say, global traders who moved the products around the world, right now it's really also, you see let's say the majors are also having their actually trading marketing arm that trades the third-party barrels. You see refineries starting trading a lot more, and you see also the US, traditional US merchandising companies that used to traditionally trade just the US market started to open up and explore the global market. So, thank you.
Good afternoon. I want to thank the US Energy Economics Association for bringing us together to exchange ideas on the impact of the US on global energy markets. I'm going to be looking, I'm going to be sharing my observations on the impact of the US in global LNG markets. And I am not a formal economist. I have an undergraduate degree only, but the title of my paper is The Eagle Has Landed, the impact of US exports on global LNG markets. Does anybody know to what this refers, the Eagle has landed?
Moon landing.
Yes, exactly. It refers to the first moon landing in 1969. Neil Armstrong radioed down to mission control in Houston and said, the Eagle has landed. And actually, the way we talk about LNG in this town, in Washington, D.C., on a policy and on a trade level, the way we talk about US LNG in Houston, just on a physical basis, the physical cargoes that are coming out of Houston or the US Gulf, the amount of volumes that's going to be coming out of the US Gulf in the future. And then the way we talk about US LNG in Asia, in Singapore, for example, the way that buyers talk about US LNG, you would think that, for God's sake, we're landing on the moon, when in fact, the US has been exporting LNG since 1969, but things really are different now. And what we're seeing with the US LNG that's coming out of the US Gulf today is that it really is upending global gas markets in a way that we're not seeing with the U.S. exports of crude, because the crude oil market is fairly well established. It's fairly liquid. This is not the case with the U.S. And so the U.S. is having a tremendous impact on global gas markets for three main reasons. Number one, on the supply side, the US LNG that is being exported is totally and completely 100% flexible in that, the very, very basic definition of flexibility is that you can lift those cargoes if you're a capacity holder, or you cannot lift them. You can leave that gas in the ground, you can trade it into the Henry Hub, you could trade it into the US market if you want. And this is compared with the volumes that we see from other liquefaction plants around the world, where those cargoes are generated, whether you want them or not. You pay for them whether you want them or not, because moving on to the demand side, those cargoes are not destination flexible. So in the US, second way that it has upended the global gas market is that the volumes that are coming out of the US are destination flexible. And what this means is that once you choose to lift the cargo for which you have capacity, you can send it wherever you want in the world. You can put it on whatever, it has to be an LNG tanker, so we haven't really changed the market that much in terms of the physical way that you liquefy it and that you ship it and that you regasify it, but you can put it on whatever LNG tanker that you want, and you can put it to whatever market you want. And finally, on price, and this is where the US is going to have the most profound impact on global gas markets, is that you can sell this gas at whatever price you want. So the US LNG is being sold on a Henry Hub basis as opposed to an oil index basis, which is the way LNG has been bought and sold in the past. And what this means is that the US is emerging as a viable alternative to oil indexation. And that is really the game changer, because that is really something that buyers and even sellers alike have really struggled with, this idea of oil indexation, this idea that in Asia in particular, that there's no other sort of pricing or benchmark options for which to sell your gas except for oil, which can be severely flawed. So, as far as the fundamentals go, where are we now? In 2018, we are looking at roughly 40 BCFD of LNG cargoes in the world. We are in the middle of a significant supply push globally for LNG. This is not just a US story, this is a global story, primarily emanating out of Asia. And so from 2015, we've seen significant supply additions to the LNG market. The thing about the supply additions that we have seen so far since 2015 is that they are coming from traditional trading structures, in that the LNG that's coming out of Australia, that's come out of Papua New Guinea, is being bought and sold on the sort of traditional destination clause oil index basis, and so there's not a whole lot of flexibility. So in 2016, the US exported its first cargo, and this is what we're looking at over the next 5 years in terms of capacity additions in the US. Important to remember that the US is really only just starting its process in terms of liquefaction additions. So when people say, well, where's the oversupply? Where's the liquid gas market? Where's the Henry Hub indexation in Asia? All I can say to you is just hang on a second, it's coming. We only have 2 export projects operating today, and we're waiting on 3 more. So a significant amount of supplies being added to the market from the US. Right now, US comprises about roughly 5% of the global LNG market, with around 2.5, 3 BCFD of exports. That's gonna move by 2023, 2024 to 20% of the global LNG market. So I want you to just stop and think about what that means for a second, because 20% of the global LNG market being sold on a Henry Hub indexation, whether or not it actually plays out that way at the end of the day when you look at the DES shipping data, remains to be seen. But we're talking about 20% of global LNG is being sold on a liquid benchmark basis that can be hedged, that can be optimized. That is a significant change. That is probably the most significant change. As far as where we are specifically in the US, this is a look at the supply additions that we're going to be seeing over the next couple of years. The black line here represents the delays from our outlook last year. And what's important to remember about the delays is that it's really causing a knock-on effect for a number of trade issues, not just the ones that I mentioned earlier, and that we're still waiting for that liquid market to appear because we're waiting on the US LNG supplies. That's one issue. But we're also seeing a knock-on effect by the delays in US LNG capacity, a knock-on effect for the next generation of supply. And so right now, buyers are looking at this market and they're saying, hey, we need, we're going to see another, 6 BCFD of LNG supplies from the US that's flexibly traded and marketable. I don't really need to get that worried about the next generation of FID. Meanwhile, suppliers are sitting there thinking, oh my God, the market's going to clear. I mean, optimistically, they're saying 2021. It's our view that we're looking at around 2022, 2023, but you need to start making those decisions now to have that next generation of supply. And so we're globally, in terms of the LNG market development longer term, we're still really in a holding pattern. And bringing back to what's actually happening today with the trade war with China, this has another veneer of stalling the next generation, because when we think about the US as the next largest potential supplier beyond 2022, beyond 2023, and we think about China as the largest potential incremental buyer of LNG, the fact that the U.S. or that China's implementing a tariff on U.S. cargoes and that the U.S. is talking about increasing trade barriers with China is really going to prevent the required investments in U.S. liquefaction on the part of Chinese buyers, either directly or indirectly. So what's happening now is having an impact on the future. So let's move on to the demand side of the implications for the U.S. And what this is a map of all the destinations of U.S. LNG cargoes since the fourth quarter of last year. And a number of things stand out. Number one, what stands out to me, aside from this being a really beautiful map, that the production people in my large company are responsible for, because I like Margarita, do the little maps with the little lines, is that U.S. cargoes have really appeared everywhere in the world. And this is quite interesting, because if you think about the idea that the U.S. should be optimizing its cargoes because there's this ultimate flexibility, they should be going to the highest price market, they should all these U.S. volumes really, on a netback basis, primarily in the winter, should all be going to Japan, they should all be going to Korea, they should all be going to China. They should not be going to Malta. But the important thing to remember is that while the US LNG is flexible, there are a variety of different capacity holders who all have their own portfolios and their own agenda and their own requirements to meet. So number one, capacity holders of US liquefaction are the portfolio players. So your Shells, your Gas Naturals, you could even argue your India Gale. But they're not just buying this LNG for the hell of it, hoping to put it into the best price market. I mean, that's one option, but they do have other portfolio arrangements that they've made with other buyers. And so you may see, you know, in the case here, which I'll get to in a second, I need to think of a better word, a lot of cargoes going into Mexico, and you may be wondering why, and it's because Shell has obligations to the Mexican market that they need to meet. Another reason you might not see full optimization is that some buyers, particularly the end-use buyers in Asia, so your Tokyo gases, your TEPCO gases, your Korea gas, your GS Caltex, they bought the US LNG for a number of reasons, but one of them is to meet demand in their home markets. And so even if they could get a better price somewhere else, for now at least, they tend to be, what we've seen is they tend to be bringing these volumes into their home markets as opposed to trading them or swapping them out somewhere else. And then, you know, finally, you do have the optimization that happens with U.S. LNG cargoes. And this we tend to see more on a seasonal basis. So in the fourth quarter and in the first quarter, you know, you'll see something like we saw last winter where some 56% of U.S. volumes were all going to Asia and mostly landing in, or primarily landing in China. Also on the demand side, this is a look at the top U.S. buyers of U.S. LNG. So the number one buyer is, in fact, Mexico. And this is very interesting because the U.S. is also a very large exporter of pipeline gas to Mexico. But part of what's wrapped into this situation is, again, contract obligations that Shell has to the Mexican market that going back into the deep, dark history of the LNG trade, we're supposed to be met by Peruvian supplies. Peru and Mexico had some differences of opinion on the contract, which incidentally was linked to the Henry Hub back in the day, back when Henry Hub was $13. Peru thought, this is great, we're getting a really great deal. When Henry Hub went down to $4 and then $3 an MMBTU, all of a sudden Henry Hub gas from a supplier perspective isn't looking really too good, and so this contract is in arbitration. But anyway, Shell did have to meet these obligations. That's the story with Mexico. The other thing about Mexico that's interesting to remember is that the U.S. not only is an LNG exporter, but also a major pipeline exporter. And ultimately, Mexico is probably going to go away in global markets as an LNG importer as those exports to Mexico via pipeline increase. Then you have the second largest buyer of U.S. LNG, which is South Korea. And here you see it emerging on, you saw it initially emerging on a seasonal basis in, last winter in January and February of the winter of 16-17, colder than normal winter. You saw a couple spot cargoes going into South Korea. But then interestingly enough, what you see here is sort of this steady volume of US cargoes going into South Korea. This coincides with the startup of Sabine Pass Train 3, the capacity of which is contracted to KOGAS. And so this again is an example of end-use buyer buying LNG from the US, bringing it all the way to South Korea, even if maybe they could have better options selling that gas into Europe or into the Middle East. And then finally, the third largest buyer of US LNG is, of course, China. And this is very, very interesting because China does not have any direct capacity agreement, offtake agreements with any US suppliers at this point. And this trade situation that we're seeing now, this has actually been a long-standing thing. There has always been mistrust between Chinese buyers and US suppliers about the ability of the political risk factor of the US buying directly into US LNG projects. But we have in fact seen China emerge as a fairly, on the US side, maybe not on the Chinese pool side, but China's a significant buyer of US LNG. And again, this shifts on a seasonal basis, but in the winter you can see China accounting for something like 25% of US LNG exports. So this is nothing to sneeze at. In recent months, as talks of the tariffs have heated up, we actually haven't seen any reduction in US exports to China on other than a seasonal factor. And it's our opinion that with the 10% tariff implementation, we're probably not going to see, a cessation of US LNG exports to China, but there will be a price to be paid. And this is something that portfolio buyers and sellers and Chinese buyers themselves are in the process of trying to sort of redivert their cargoes in order to anticipate any developments in this trade tension that we're seeing. So I want to move on quickly to price. And what we have here is a Venn diagram, because I understand that economists love Venn diagrams. And so I had our team in Singapore look into the issue of how do we actually quantify the impact of US LNG on global markets on a pricing basis. And the reason I put that question out there is that it may seem very obvious that US LNG is priced, the pricing is broken out in a very specific, very transparent way, so you can easily calculate what the delivered price of a cargo of US LNG should be. So you have your Henry Hub, $3. You have your 115% fee, that's the Cheniere marketing and transport fee to get that gas into the liquefaction plant and liquefy it. So your Henry Hub plus 115% is the Cheniere terms. You have your liquefaction fee, which for the Sabine Pass ranges from $2.25 to $3.50 for the Corpus Christi trains. And then you have your shipping costs, which can vary if you're using spot tanker, what the spot tanker rates, what the long-term charter rates, but you can pretty easily calculate what your delivered cost is going to be. And what we've seen when we look at the pricing data is that when we look at the pricing data, like the delivered prices of US LNG into China or Japan or Korea or India or wherever we have the pricing data, is that it's really hard to tell what's going on. And it looks like US LNG is being priced at market prices, which makes sense. It's priced at the JKM. It's priced at sort of something close to an oil indexed price. But what we want to look at is how the US is changing. And so while it may not be completely quantifiable here, what we have is in this Venn diagram is these three options for pricing and how the US Henry Hub fits in. So you have your Henry Hub price right here. And this is, of course, the US volumes. But what, interestingly enough, we're starting to see is that as some of these legacy long-term contracts are being renegotiated, as they're expiring and being renegotiated, they're being renegotiated in a hybrid basis, which is taking into account some sort of Henry Hub indexation, which is really quite interesting. Again, we don't have the full information on how these contracts are structured. It's very proprietary, but we are seeing some indication of these hybrid contracts being signed, and again, for supplies not being sourced from the US, so for other Asian supplies. So you have your Henry Hub. This is sort of like the new kid, well, it's a somewhat new kid on the block, this liquid benchmark point for which LNG around the world can be priced. Then you have your traditional oil indexed prices. And what we're seeing here in terms of the impact of US Henry Hub is that oil indexation is actually changing. So you're still indexing, the contracts are still being signed on a basis to either the JCC, the Japan Crude Cocktail, or to Brent. But we're seeing the relationship being loosened somewhat. So from your traditional contract metrics of 14.5% slope to JCC or even to Brent, we're seeing this slope come off a bit. And we've seen some long-term deals being signed on terms of 11 or 12.5% indexation to Brent. And so this is how the US is having an impact even on oil indexed contracts. And then finally we have, and full disclosure, I work for S&P Global Platts. Platts is responsible for putting forth the JKM benchmark price. I'm not in a position to talk about the pricing mechanisms of JKM, but we do just sort of, as an objective analyst, we see an emergence of the JKM, and this is what could be termed sort of a fair liquid LNG price in Asia. And the liquidity of the JKM is a function of US LNG exports. So as more liquidity is being brought into the market, the JKM becomes a more attractive and more reliable and less volatile source or less volatile benchmark for long-term contract indexation. Now, of course, there's problems with this because there is going to be a considerable amount of volatility associated with JKM. So you're going to see the price spike as we saw last winter and possibly in winters to come, where JKM is actually reaching oil parity. And at the same time, the reason suppliers are reluctant for this kind of pricing structure is that in the second and third quarter, you see JKM being sold at a massive, massive discount to oil indexation. So there are some reasons for not adopting the JKM, but we are seeing sort of more hybrid contract structures in place as a result of US LNG. And that's just these markets, these three pricing structures are going to become more interrelated as more US LNG appears into the market. And so, semi-finally, I have one more after this. This is a look, again, it goes into this problem of trying to sort of define how the US, what the US price into Asia looks like compared to an oil index price. And what we're seeing is what this is showing is that in the early days of US LNG exports, there was a considerable amount of volatility in the pricing, in the prices that were delivered to Asia. And as the US emerges, as the JKM price becomes more liquid, what we're seeing is that US prices are really converging with with Qatari delivered prices into Asia. And of course there's a symbiotic relationship here because Qatar is making some concessions in response to the US volumes. And on that, I'd like to close with the fact that what's happening in the US is not happening in a bubble. So we're having all of this US supply hitting the market. It's really going to come to sort of a critical mass at the same time that globally many, many contracts are coming off of their sort of long-term 20-year life. And what this shows you on this chart on the left is the massive amount of contract expiry that we're seeing that we're seeing globally that's happening, you know, at the same time that US volumes are coming into the market. And this is something that Qatar in particular is going to have to deal with, because as they're renegotiating some of their contracts, or they're renegotiating all of their contracts, buyers are insisting on some of the things that the US provides. Buyers are insisting on destination flexibility. They're insisting on seasonal flexibility. They're insisting on moving away from oil indexation. So thank you very much for your attention. I'm going to turn the podium over to Ron.
Yes. So I'm the academic on the panel. What I'm going to work through here a bit is the new Chinese crude oil futures contract. Many of you may well be aware that they finally have opened that contract and started trading that contract, started trading on the 26th of March this year. I'd actually been waiting for over 5 years for that contract to finally be available for trading, and I happened to be in Beijing for almost all the month of May, so I got to watch a lot of the internal stuff. But I also learned an awful lot while I was there, and one of the main things that I want to do is I'm hoping that a lot of other people are going to dig in and try to understand this contract, presuming that it actually lasts long enough to really do a lot of analysis. But to make sure, part of what I want to do is there's a lot of misunderstanding about this contract and what the information is that's available on it. And there's a lot of information available on it. There's a lot of really interesting things the way they present it. But it's very different than what we are used to on either NYMEX or ICE. So what I'm hoping to do is to sort of provide, I'm a professor, I'm going to do a little educating, right? So this is the language associated with the contract. I'm not going to go through all of it, but I'll point out some of the key differences. Number one, if you're aware of the contract, you know that it's actually the first futures contract for crude oil that's been priced in something other than US dollars. It's priced in renminbi. All right. It's still 1,000 barrels to a contract. They call their contracts lots. So if you see lot, except I'll show you a little bit later where sometimes they say lot and it's not really contracts, and that's an important point that we'll get to. There are interesting sort of caveats that slide into some of the language. For instance, you'll see under trading hours. Now, this is something that's different than what we see on either NYMEX or ICE, but it's quite typical in Asia where they have a morning session and they have an afternoon session. On NYMEX or ICE, they open up, they start trading, they trade all day, they do a little pause, they trade all night, it just keeps on going. But for the Asia contracts, they have their segmented trading days. The interesting line here is you see from 9 to 11:30, then you see from 1:30 to 3, and then the phrase other trading hours as prescribed by the exchange, which means they can do anything they want, which they do. And then you see what I've got there in blue is what I refer to as overnight trading, because it starts at 9 p.m. Shanghai time and runs until 2:30 a.m. Shanghai time, which is exactly 9 a.m. New York time to 2:30 p.m. New York time. And that's important because we'll see in a little bit with a little more detail, most of the trading happens then on this contract. All right. And I think that will also provide some understanding for why I see some linkage going on, but also some direction of flow of information, causality, that sort of thing. One of the things, I'm on One Energy blog, I don't do blogs much at all. I'm on One Energy blog, and a bunch of people were really, really agitated by the delivery period, because the delivery period is the delivery of still open contracts has to be done within the first 5 days of the delivery month. So a number of people on the blog were saying, well, okay, this is not really a futures contract because it's really all about accessing supplies and the like. Well, if they knew something about the Chinese contracts, they wouldn't necessarily think that, because every commodity futures contract that trades in any commodity in China has delivery through the first 5 days of the delivery month. So it's actually just a specific characteristic of the trading structure and regulation that they have in China. My perspective on that, and it seemed to be confirmed by a number of people in China that I think, well, I trust their judgment because I thought I was right. But it's the Chinese government detests speculation. Back in the mid-90s, there were more than 80 futures exchanges across China, and because a lot of them, including at least one that had oil contracts, they basically were deemed to be or viewed to be speculative gambling houses, and we now have 3. They shut them all down, and then they slowly opened them back up again, and we haven't gotten the crude oil contract back until now. So, to me, the idea of having to deliver all of your deliverables in the first 5 days is that kind of gets rid of the people that might hang around that wouldn't be there otherwise. Okay? There are, what do we got? Seven deliverables against this contract. One of them is China production, the Shengli. And you see over on the far right-hand side that 4 of them are deliverable at par, one of them at a 5 RMB premium, and the other 2 at a discount. It's also worth noting in there that Omani crude is one of those crude oils that's deliverable. Omani crude is the crude oil that is the underlying for the futures contract on the Dubai Mercantile Exchange. And once this it'll come up again later. Once this contract started trading, basically the first contract that was traded was for delivery in September, so this month. The trade has never really been very strong on the DME, but basically September trade on the DME went away once this contract started trading. And since this contract, the September contract has already come to the end of its trading. It's already passed its 5 days of delivery, and one of the reasons why I'm not overly confident that this contract is going to be successful is there's been absolutely no interest in October, no interest in November. November is still actually trading, and I think October is still trading on the DME, but all the interest has moved to December. The December contract in DME is gone. There's nobody trading that. So it's having an impact on the DME. What we'll see here in a little bit is I don't think it's having any impact at all on the NYMEX or the ICE. And I think it's worth noting that this structure of delivery over a range of different crude oils is basically the same thing that we have for the NYMEX contract. Everybody talks about the NYMEX contract as the WTI contract, but it's not the WTI contract, it's the light sweet crude oil contract. WTI just happens to be the main one that has been deliverable against that. This gives you the comparison between the 3 crude oils on the INE, the Shanghai Exchange, NYMEX, and ICE in terms of their API gravity and their sulfur content. And one of the more important things about this is that the crude oil, the medium sour under the INE contract is very different from that's traded on NYMEX or the ICE. And in some ways, it seems like it's a reasonable thing to fill a void in the global marketplace for risk mitigation. Many of the things that have been written about this contract, most of it's wrong, but many of the things that have been written about the contract were suggesting that it was all really about trying to take away market from NYMEX or take away market from London, the ICE. It's a completely different crude oil. I think it's actually, if anything, it may fill a needed niche, but I don't think it's really going to do much to the other two. Now, what I haven't read up here is the most important thing if you're going to do any research on this contract. Because in all of the commodity contracts that exist in China, they do what they refer to, they use different phrasings depending on which of the three exchanges you go to, but they use what they refer to as double side counting, which means every number that you see that they're reporting that has to do with trading volume or open interest has to be divided by 2 so that you actually know how many contracts are being traded and how many contracts are open. And they're doing that, well, I really don't know why they do that, because in fact, I think maybe it's easier for whatever accounting system that they have, that both the long and the short of the contract are paying a fee, and they're just capturing that by saying it's 2 when it's only 1. Just so you really believe me, it says right there in the footnote, double side counting. The other thing, both on this slide and the next one that actually it's maybe 2 more. If you take a look at the column for volume and the column for open interest, there is never, ever, ever, ever an odd number in there, which is statistically pretty unlikely unless they're doing the double side count stuff. All right. Another very interesting thing about the way the contract works and the way things are reported. In a lot of financial analysis, we end up with what's frequently referred to as a Monday effect. This contract is going to have its own really very interesting Monday effect, I think. Because remember I told you that the most trading happens in that overnight trading cycle. But that overnight trading cycle is added to the next day. And if it happens to be a weekend, the overnight trading cycle is from Friday night at 9 o'clock until 2:30 in the morning Saturday. That's added to Monday. So when you look at the Monday numbers, and the way this has been trading, over 70% of the volumes you're talking about and the impact on the price was all done a day and a half to 2 days earlier. So how are we really going to wrap that into a full understanding of what's going on when trying to compare it to the other contracts around the world is going to be a bit of a challenge. This one's really hard to see, but this is really just to show you again here what's being reported are the total numbers for all contracts that are open. Usually it means the one contract that was the focus in a few trades and a little bit of open interest for everyone else. But again, all of those numbers are even numbers. All of those numbers have to be divided by 2 to actually get down to a comparable set. Some comparisons on trading activity. This is the September contract. It was a date when I was in Beijing, so I pulled it off. And the next slide will show you similar numbers for the December contract, which is trading right now. But I wanted to do some comparisons for a couple of reasons that will come out more later on. But part of it is to show that it's hard to see here that there's been basically no impact on trading activity on the NYMEX or trading activity on the ICE as a result of this contract coming into existence. To give you an idea of where the shares are in terms of open interest across the 3 and trading volume across the 3. But the pricing panel I think is interesting because several of the pieces that have been written about this contract is there has been, many of you would know that there have been a lot of articles written about the so-called Asia premium for oil and natural gas and pretty much everything else that sells in Asia that's coming from outside in terms of basic resources. To me, it's always just been, that's what it costs to get it there, so that's why it's a higher price. But the suggestion was that if we could just get our own futures contract, get our own benchmark, then we will get a real price that isn't, we'll get away from the Asia premium. Well, the price on the INE is higher than NYMEX, not that far off of ICE, and almost exactly the same as the price in Dubai. And it also turns out, I only had a 3-month window that I could look at the overlap, it's almost the same as the JCC. So it hasn't really changed anything in this time frame. Now, part of that could be that it's really not that heavily traded. It's really not reflecting the market as completely as we might like, but nonetheless, there's no giant move in the direction of a lessening of the Asia premium. What I know in this, the lower right-hand box is to make these comparisons are a little difficult when you really think about it, because for the even for this December contract, when I did this, the INE, the Shanghai still actually had an October contract and a November contract open. That's one of the other things. There's no little footnote about when they might decide to go ahead and shut down a contract, but according to the specifications for their contract, the October contract should still be traded. They stopped reporting it yesterday. I don't know why. There's still days that are supposed to be there. Nobody was trading it, but they've closed it down. All right? But you've got the ICE closes down its trading on a contract a month earlier than, or basically a month earlier than either NYMEX or than the INE does. And when the initial contract on the INE was there, their first contract was for September delivery, but at that time there was still May, June, July, and August trading on NYMEX and trading on the ICE, and that's where most of that trading focus was in the first place. But this still didn't really seem to impact on their trading activities. One of the things I like as well is that makes it different and challenging is they have their own banking holidays. They have their own days off. And I used to be a dragon boat racer myself, so I really like dragon boats. But they shut down for about 5 days for Dragon Boat Festival over that period. You can see the spike that happened. It did react to Trump's Iran announcement. But I think an interesting thing about that is my recollection is, because I think I was probably still in China when that happened. The announcement was actually made at something like 2 o'clock in the afternoon here, so there was almost no trading time left here, but there was lots of trading time left over there. And that reaction, you can see with that spike that happens. The big drop-off there that happened in the trading volume was because they were all out paddling their dragon boats. And the big spike to the further end there is really right at the point where this contract was coming to an end. That's the big spike is on August 8th, and the end of August was going to be the closeout of this contract. And basically through that whole period, all we have is open interest declining and being closed out. Which I think is another interesting thing about the characteristic of this contract is that on the last day, there were 601 contracts left open. All right, so not an awful lot of volume, but in a sense, it sort of mirrors or is very similar to what we see with our contracts on NYMEX if it was really being used for hedging, which I think that there was a good likelihood of that, and I'll talk about that in a moment. It's much like what we do here, and that is that the contract is used almost exclusively as a market price hedging mechanism and not a way to access or get rid of crude oil. And this is demonstrating exactly the same kind of characteristic that we would see. This graph and the next one are mostly meant to try to show, it's kind of messy, so it's kind of a bit hard to tell. It's meant to show that the existence of the September contract had no impact on the Brent contract, because the dark blue line is the INE trading volume on this. The other 3 lines that are there are the 3 prior years' September contract trading pattern through the cycle of the year. And you can see that the bright yellow one is actually this year's September contract on the ICE, and it's right in the same kind of pattern activity of trading that had existed 2 years before when the INE contract wasn't there. This one, I probably should have done a different right-hand scale for the open interest, But I think this is really important to do it this way. The open interest on the INE is basically nothing compared to the open interest that exists on the ICE, and it doesn't appear to have had any particular impact on the pattern that was there. Now this, I'm really kind of interested to get some feedback on this, because I just had sort of, I think, a new insight about this as I was sitting back